we've been invested in Glaxo now for about 2.5 years. We still think it's a compelling investment, and we're very happy to. We've actually invested a bit more in it quite recently. When we invested, the share price was down at around sort of £11–12. Today it's at about £14, and it's delivering us a 5% per annum dividend. So we've done pretty well for the last 2.5 years, but we think it's a compounder. We think this is a good example of a long-term investment where our view of its intrinsic value has gone up ahead of its share price increase. Probably not quite as fast as the share price increase, if I was to be honest, but there's still a good margin of safety. Today, the current the sort of forward-looking PE is around 11–12, and we think that for a business of this quality, that's quite a reasonable margin of safety for us. When we started looking at Glaxo, the thing that was obviously on everybody's minds was the issue of patents running the patent cliff. And what we were surprised about when we did the analysis, and if you looked at sort of Pfizer and AstraZeneca, those patent cliffs are really extreme. What we were surprised about with Glaxo was that when you actually look at the individual revenue streams and individual drugs, and they give you quite a lot of data on this, the patent cliff wasn't nearly as bad as we expected, and that we felt that was being baked into that share price. And not only that, you could take some. I mean, what one sort of model that we ran was a hypothetical model where we said, what if the business stopped doing any R&D today, and it just ran its business for cash? And what we found was that the business would generate as much cash in the next sort of 7 or 8 years as its whole market cap. So what that said to us was that the real issue for Glaxo was whether or not we felt it was getting a good return on investment from its R&D. And here we had to do a lot of digging around to try and get a feel for whether or not Glaxo was doing the right things to drive its R&D return on capital up. And everything we saw we were impressed by. There was a lot of commentary within the company about their targets for increasing return on capital, and as we've tracked over the last 2.5 years, they're doing that. And what they've been doing is cutting a lot of cost out of R&D, focusing the R&D in a much more enterprising and entrepreneurial way, using a lot of access to effectively outside resource by doing joint ventures with small entrepreneurial biotech companies, and bringing some of the sort of effectively venture capital discipline into their R&D process, which I think has been missing from the pharmaceutical sector for a very, very long time. I mean, in the old days when they were bringing out these blockbusters, R&D budgets were literally unlimited. I remember when I was working in the IT world, interviewing a Pfizer MBA who worked there in the sort of downstream part of the IT spend, looking at marketing and distribution. And he told me that the IT budgets were incredibly constrained where he was, and they had very high return on capital discipline. But in the R&D world, it was literally there was no discipline. And I think that's been existing for a long time. I think Glaxo was one of the first to start changing that culture. And then you look at Glaxo at a sort of broader level, the pharmaceutical sector as a broad level, and the reality is that the players in the pharmaceutical sector have not changed for 40, 50 years. You look at the top 10 companies. Yes, there have been mergers, but if you strip those out, it's the same companies offering products. And the reason for that is that it's actually become more and more difficult to get product to market. The regulatory hurdles are higher, and effectively these businesses have become massive distribution vehicles for the biotech sector. So they buy up drugs at an early stage, put it through their incredibly complex infrastructure, very difficult to replicate, and then have this fantastic distribution that they're able to get their drugs out to market. In addition to that, Glaxo has a very vibrant and growing consumer healthcare division, which underpins its valuation, and it continues to, the underlying business is continuing to grow. And it has these pharmaceutical companies are getting a lot clever about how they retain access to their patents by, in some cases, creating brands around their healthcare products, and in other cases building devices, in Glaxo's case around its asthma products, which sort of extend its patents out. And their big growth stories, obviously, the developing world, where they're all growing at very, very high double-digit rates, which is offsetting sort of somewhat lower or slow growth in Europe and the US.
So where do you estimate intrinsic value there, and what sort of return do you expect to make from here?
Yeah, so our view of intrinsic value is that it's sort of around £22. It's currently £14. It's dividending out 5% a year. So if you work that through, we think that that's going to be a 15 to 20% per annum return if the market sort of were to return it to intrinsic value over a course of 3 years.
I'm just curious also in terms of getting to that intrinsic value, if you could break down the price in terms of their existing product portfolio and then the, if you will, the pipeline or the return on the R&D.
I mean, the way that we look at that is that was in a sense what we were trying to do with that model, was trying to create a base case. You know, do we have comfort that this business model is fundamentally valued on a sensible basis? The way that we're valuing the business today is to say we think that its cash flows are very predictable, and so it's on a simple discounted cash flow basis, saying on the basis that these cash flows continue to generate, that it gets a relatively modest return on capital, that it continues to reinvest. I mean, all that R&D is not capex; it goes through the P&L. We get to a valuation of £22.